They spend about 60 to 70% of the time analyzing the market through the big fundamental, right? Then they spend very little time, 30% of the time. Once they know exactly what currency to buy, what currency to sell, the next step is they go to their charts. If I want to buy a particular currency, example, I want to buy the euro, where should I buy? Of course, obviously you want to buy as low as possible, right? On the other hand, if you think that a particular currency, Australia, is going down, right? Because China has slowed down. Why that affect Australia? Because Australia export a lot of mining product to China. Their whole entire economy basically depends on mining product, right? If mining product drop, the demand drop. China economy in China slow down, therefore demand for mining product drop. That will guarantee affect Australia economy, right? If Australia economy affected, what happened to their currency? It's going to affect it as well, right? So we know that we want to sell the Australian dollar. So what do you do? You want to sell as high as possible, not at the middle, not at the low. Am I right? So you can see that most of the big institutions, when they want to trade, right, they always start off from the fundamental. Then the second step, they go to the technical. Now let's say example, if they want to sell a particular currency, Australia, because of the China factors, right, and they know that they want to sell at this level. The current price is here, current Australian price is here, but they want to sell here. So what do? They do nothing. They wait for price to eventually come to this level, then they sell. As long as the price don't come to this level, they do nothing. Right? Then you might be asking, if Australian economy is affected by the China, how can Australian price, the value of Australian currency go up to this high? How it can? Why? Because of the currency is traded in two pairs. Australia could be against the US dollar, or Australia could be Canadian dollar. Now, the Australian currency, right now current price is here, and you want to sell here. What can potentially cause Australia movement here? It could be some daily news come out from Australia, right? Some those news which I call noise come out from Australia, and they push the Australia higher. Or it could be news from the other currency pair. Example, you're trading Australia against dollar. It could be dollar has some negative news. So when the dollar drop, negative news, dollar drop, what happened to Australia? Australia price go up. Can you see that? So you can see that even though Australia is considered weak, but it can still go higher because of the daily news, right? Which you see all the news on the forest calendar, right? So now, to a big institution, they know exactly what they're going to do. They only want to sell here. This is the area they want to do business. So long as the price don't come here, they are not interested. Do you understand what I mean here? Just like example, if you want to invest in the real estate, right? Then say the real estate is the value right now is 1 million. The 1 million to you is way too high. You want to invest, but it's way too high. You have your ideal price. Your ideal price is if the price can come to 700,000, I want to invest. So long as the price don't come to 700,000, you do nothing. Am I right? That's trading. Alright, that's trading. So in